after I started reading this book that I just picked up the last couple of days, and the book is called Money Master the Game by Tony Robbins. Seven Simple Steps to Financial Freedom. Kind of, I didn't understand that small, the impact of the fees of these funds had on you as an investor in the long run. And what I mean by that is, as I saw, you lost my last couple of videos. The reason why I love index funds and ETFs. Hey everyone, we're back, and I want to, as always, here sharing my thoughts, and especially where we're here as my new part of my series where we're focusing on building our wealth, long-term wealth, and little by little, day by day, increasing our financial literacy, understanding a little bit more about a lot of the things that we weren't taught, unfortunately, in school, at least not in my school. And if you were from anywhere from the not suburbs, urban areas, minority neighborhoods, I grew up in New York City, public school, you didn't have a lot of information with regards to your future wealth, retirement, investing, budgeting, anything when it comes to your financial health, even in your physical health, right? So as I got older, I realized that there's a lot of things that we're not learning and we don't know until we get a little bit older. And for me personally, time is one of the golden things that at the end of the day, it really matters to most of us. It's more important than money. And as older we get, the less time we have to build our wealth. And sometimes we might get to an age that we might need to catch up, or it might be too late. So if you're just right now leaving college and you're getting your first job, this might be a great time for you to watch these videos and learn a little bit more about your financial literacy. Understand that what you know does matter in the long run, and what you don't know does hurt you. Unfortunately, we kind of understand that we live our lives, and hopefully we learn along the way. And you learn as you go. But sometimes when it comes to building wealth, it's actually benefits you to learn as soon as possible, so that you don't have to suffer the hurdles and the losses that will deter you from building your wealth. So when I was doing my research and I was trying to implement how can I distribute this information as easy and as kind of as informative as possible, I started realizing how much I didn't know, how much I still was learning. Even though I worked in finance in my early days after college, back in 2006, 7, 8, 9, right before the 2008 crash or recession we had, and how much I still didn't know, even though I worked in those areas, in those fields, as a representative for these big banks. I still didn't know a lot. I didn't have investments myself. I didn't really buy any of the products that I was selling. And we were trained to certain products, and we just pushed the products, and it caused me not only the crash, but also caused me how, in a way, it made me feel weird because I didn't want to push products on individuals that I didn't think that they were going to benefit from. But at the end of the day, we had sales goals, we had incentives, and if we didn't meet them, we were basically on the verge of being fired every month if we weren't meeting these goals. And that's where I kind of realized that I didn't want to be in the industry. I didn't want to be in that situation, and not the best interest of my customers be the first priority. So that's my small story. But now that I'm realizing, and I'm like coming back to it, and I'm like, okay, let me see what I was missing. And as we're building our future wealth, I realized that I still want to do some learning. I did learn a lot when I was working there. I know different asset allocations, different funds, tax advantages, and all different sorts of vehicles that could help the wealthy. But how about us, the average investors, right? individuals just trying to build wealth in the long term, and not necessarily per se have the wealth right now. And the funny thing is, back in the day when I say back in the day, but this is back in '07, '08. There wasn't as much vehicles as we have now to start investing at a very simple way. You had to have either a large money to put in, anywhere from 5,000 to 10,000 to start any type of account, or there wasn't that much access that there is now because the internet has kind of paved the way for such easy access to start putting away money for your future. And at the same time, you still have to understand, doesn't mean that it's a good thing, because sometimes we're very easy to, excuse me, very easy to put in and to take it out very, very easily when we get kind of bad news or the market takes a toll. So it's good and bad, but definitely we have a lot more access than we did, I would say, 10 years ago. So because of that, I'm seeing a lot of individuals, especially young individuals, as we call them, the I believe it's the Gen X, might be mistaken, but or the Gen Zers, I think it was Gen X, that they're investing in. They're putting a lot more attention and information that they're coming to them, that they're putting the money to work. So with that being said, I really wanted to learn on what's the best way, or what's kind of the easiest, or not easiest, but the most passive way that we can invest. And I was wrong coming up to now. This is kind of the part of the video I wanted to just share a little synopsis of what my story is. But before I say that, but I learned how wrong I was because after I started reading this book that I just picked up the last couple of days, and the book is called Money Master the Game by Tony Robbins. 7 Simple Steps to Financial Freedom. Kind of, I didn't understand that the impact of the fees of these funds had on you as an investor in the long run. And what I mean by that is, as I saw, you lost my last couple of videos. The reason why I love index funds and ETFs is because of the low fees, and you get exposure to the whole market. But the main thing for me is low fees. And think about it, and the way they put it in the book as well is, they spoke to one of the, I would say, fathers of the investment firms, Jack Bogle, and he says, at the end of the day, for the long run, if you're paying high in fees, the fees eat up most of your returns, and your returns don't add up to what you think they're going to be 10, 20 years from now because of the fees eating up your returns. So he says, in the long run, not only the average return is important, it's actually the fees you're paying on these accounts, on these funds. Because if you're making, he gives an example, if you're averaging 10% return and you're paying 3% in fees, you're only going to be getting back 7%. And in the long run, that could be a difference from you investing, instead of you keeping $100,000, you might, instead of you getting, let's say, $300,000 after 20 years, you might get $100,000 back to 20 years. So that gap is, let's say, 1% to 2% difference in fees. So the name of the game is keeping your fees low, and that is one of the most basic principles to learn when you start putting money away and you start understanding for your long-term wealth. Is oftentimes, as human individuals, we'll have this instinct as humans that we want the highest possible returns, as possible. And we will see, when I was in banking, the mutual funds will say, hey, our fund did 15% last year, or 25% last year, and not taking into consideration the fees they're charging. So one of the lessons that I'm learning and that I've learned is that before you start any type of investing and you want to start building wealth and you want to set aside money and you made the plans and you made a focus in your goals, before you go into any funds, always take a look at the fees and try to keep them. Apparently, rule of thumb is anything lower than 1.25% is a good cost for your investments. There's a lot more index funds that are out there that are below that. I mean, you have a couple of them that's at, point half percent, point 0.4, 0.03. There's a couple of them that I've seen that have low expenses, and that's going to be, I think, to your benefit. So when it comes to investing in your future and your wealth, always think about, instead of looking at the returns, yes, returns are obviously important, but if you have a high return fund but your fees are above 1%, you're not really going to be netting as much as you think. A lot of those returns are going to be getting eaten by your fees that you're paying. So if you're new to the game, if you're following me and you're understanding, just like me, how and when and where you want to invest, one rule of thumb is wherever you start putting your money, make sure your fees are low. Don't fall for this high returns game, right? A lot of the marketing tactics out there are regarding us as humans is we're looking at high returns. We don't even care what's in the fund. We don't really take a look at what kind of stocks are in the fund, are in these investments. We're just looking at the number. Hey, 20% return every year for the last 5 years. I'm in there. Not understanding what's in these funds. It could be some volatile stocks, volatile companies that might not be around for a long time. So always understanding where you're putting your money, and the fees you're paying. And which is why I'm a big advocate. And for me, it makes most sense, investing in a low fee index fund. That obviously there's a lot of them out there that just typically are passively invested and low cost, and they are basically mimicking the S&P 500, and it's kind of just a long-term investment, and that you're not investing in just these companies that have no type of history, or you're not paying high fees on the hopes that the returns are going to be phenomenal. But that's my preference. Everybody has their own way of looking at investing. But if I was to admit to you guys today how wrong I was about investing, is that I never looked at fees. I looked at fees as just a cost of investing, right? And I thought that 1%, 2%, 3% fees were low. It wasn't a lot of you were losing. But when I started seeing the numbers, especially after reading the book or part of the book, how in the long run, just 1 to 2%, 1% difference in fees eats up so much of your returns that it's crucial to understand how your fees are taken away from your returns, and to put a lot more of a focus and an emphasis on the fees you're paying. Because at the end of the day, it is your money. You're taking all the risk, right? You're investing your money, and the fund or the company that you're using, they're not putting their money on the line. They're putting your money on the line, and you're paying them to use your money to risk. And when you lose it, you still pay. They still get paid no matter what. So this is the way that kind of explains it in the book. It's kind of absurd the way we look at it, but when it comes to looking at returns, we're not even thinking about the fees. So before you do anything, before you start investing, before you start putting your money into these accounts, understand that maybe mutual funds are not the way. They're a thing of the past. We're not saying that all mutual funds are bad, but what we're saying is that most mutual funds have so much fees that in the long run, they're not worth it, basically. So look for some index funds that are low cost, passively managed, and in the long run, they said nobody, not even the top managers, top fund managers, not even hedge fund managers, where these are where the best best managers are at, where typically they're, you need at least 100 million net worth just to be part of these funds. Not even the hedge fund managers are able to beat the market. And you have the few, a couple of them that are good, but for the most part, for the most part, majority of the fund managers cannot beat the market. So just thinking about whether it makes sense to pay somebody to invest your money and promise you they're going to beat the market and underperform, and then you're the one paying the cost at the end of that bargain, really makes no sense. So whenever we do today, whatever you want to start investing, keep it simple. And as Jack Bogle says, it's as simple as just standing there and doing nothing. So passively managed, as opposed to actively managed accounts, are outperforming the actively managed accounts. So keep your costs low. So I hope this gave you some type of information. Quick note, I'm going to finish reading this book. If you ever want to even get started in your financial wealth or even financial literacy, I think I have been hearing about this book for the last couple of years. I never thought I really want to read it. I never felt like I needed it because I've kind of loved learning about finances and personal finances. But after watching so many TikToks, a lot of the financial individuals on there recommending this book, I said, you know what? It doesn't hurt to learn. Doesn't hurt to know what it might be in it that I might take away from it. So far, a phenomenal book. So far, very informative book that even it's made a couple of years back. It's very very relevant today, and might save you not thousands, maybe hundreds of thousands of dollars, and also give you a little bit more information on what investing is all about. And it's not as hard as they make it seem. And as far as the wealthy and the individuals that do it, keeping especially regular investors like yourself and I out of the loop and making it very difficult for us to understand it. So if you want to start, if you want to be more informed, pick up the book. And I will keep on reading it. I'm gonna keep on digesting it here on the channel. So hopefully you pick it up eventually and read it for yourself. But we'll review it eventually. And I'll see you in the next video. Peace.